This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Ray, thank you so much for joining me today. Super excited to chat with you. All right, Ray, you are the managing partner at L1D, which is an institutional crypto investment firm. You guys have a fund of funds with over 20 fund investments, and you also participate in direct investments with over 30 direct investments. You have invested in companies and protocols like Solana, Morpho, Near, Bitwise, Wintermute, and many more. And you also have an extensive background in traditional finance. You were a former trader, you were involved with hedge funds, Swiss Capital, Bellegarde Capital. So to kind of start us off, did you always know that you wanted to get involved in finance? Was that like a passion of yours from an early age, or was that kind of something that you grew into?
Yeah. Hey, Andrew. Thanks for including me here. Very happy to be part of the show. So I started getting interested in finance really early on, and I got the bug when my father got involved during the Asian crisis of '98, where there was a significant repricing in assets. And I got fascinated by, some of those Asian crises, the opportunity set that was present at the time. So I started reading and learning by myself. Went to university and studied engineering first because that was the safe bet. Opened up many other avenues and ended up doing a master's in finance. And was always fascinated about the space.
Very cool. Okay, so the Asian crisis. Can you tell me what was that involving? Real estate? Was that stocks? What was that? What crisis? What assets were in crisis during that period?
So, if I recall the history, because obviously that was before finishing school and stuff. But in '98, you had the LTCM crisis, long-term capital management, which was the largest relative value fund out there. That was a monster, was one of the most successful hedge funds out there, the most successful hedge fund out there. But that hedge fund was involved in a variety of global spreads. Some of them were illiquid as well. If I remember well, the LTCM crisis was triggered by the sovereign Russian default that led to one part of the market, becoming really illiquid. And so because of the illiquidity held by the hedge fund, everything became illiquid. It started impacting Asian currencies, Asian rates, and equities as well. And so the involvement was, the easiest, one of the asset classes that was the easiest one to get exposed to, which was essentially Asian equities.
It wasn't long-term capital management. It wasn't marketed like this, but people spoke about it as if it were like it couldn't lose money. They're like, this strategy, these guys are geniuses. They have like 8 Nobel laureates or whatever running it, and like they're incredible. They cannot lose. And then it caused they melted down completely, and it caused this massive crisis. So I guess like did you take away anything? I mean, again, you were young, but do you take away anything from that? Like, oh, I guess there are no strategies that are just always win, and it's just impossible to develop something like that.
Yeah, for sure. I in fact met maybe that was in 2006 or so. I met with one of the main founders of LCM, who reinvented himself and set up again. So that was really interesting. I met him in Zurich. Well, John Merriweather, who's well known. You can Google him. And that was before the 2008 crisis, which was really interesting. But essentially what I learned at the time is the fact that in 2005, I was trading spreads on the interest rate side of things. So I was trading yield curvatures, which are market neutral in nature. And I realized that those are strategies that are short vol. So very high sharp, short vol. But when you're short vol and you mix a short volatility strategy with potential illiquidity, this is where you could blow up, because as you might know, those are strategies that were expressed with very high leverage. And so this is one of the reasons why at the time the Fed and many of the banks had to intervene together to save the LTCM essentially to save the market. So the lesson was, whenever you're exposed to high Sharpe ratio strategies, you need to make sure that you compensate for that short volatility. So many of those strategies in 2006 that came back to the market blew up again in 2008, and there was maybe one hedge fund out there that survived. And I remember, because we were invested in that one. It's one called Capula, where they would run those arbitrage interest rate strategies, but they would always have a tail risk strategy attached to it to make sure that when things blew up, they compensated from that short vol strategy. And I think that is very relevant in crypto, because in crypto, you have a lot of market neutral strategies that, or let's put it this way, TradFi, favored. One of the biggest complaints in crypto is how volatile crypto is. So why aren't you investing in crypto? Well, it's too volatile. So a lot of products come into the space with products that suppress the volatility itself. And this is why I think suppressing the volatility can be extremely dangerous, and can lead to major realized losses in crypto as well. If I had to link that experience to crypto, I would say that shaped that experience in a significant way.
That's very interesting. I want to dig deeper into that, but before, I want to talk more about kind of your journey into crypto, because digging in your background, you're a trader, and then you're at Swiss Capital, which is looked to me like a hedge fund, and then Bellegarde Capital. And I saw on the Bellegarde Capital website there was some involvement in blockchain funds. Is that where you kind of got your entryway to crypto, or how did you first surface Bitcoin and all the other coins and ecosystem?
Yeah. So in 2005, I believe I made a career mistake. So I went from trading interest rates really successfully, and I joined a fund of funds, actually, on the traditional side. And that was a big mistake, because I think fund of funds at the time were very mature and were not interesting as a product or a model. And it wasn't in my DNA to run a fund of funds, to be fair. That's what I realized. But the upside of joining that fund of fund was that I met, it was a prominent one, I met with some of the smartest hedge funds out there. But there was one manager that blew me away, was exceptional compared to everyone else. It was Peter Thiel. So we as a firm were invested in Peter Thiel's fund at the time. He used to run a macro fund called Clarion. And I was 26 years old at the time. And so when Peter would come to Zurich to meet one of his investors, I used to be his counterpart as a 26-year-old, which frankly was a mistake from our firm's partner, because why should you miss out on, getting to know Peter Thiel, one of the smartest guys out there. So aside from, having discussions in 2006 with Peter about, the looming, real estate crisis in the US, and how, banks were going to collapse. And because, we were discussing about his short stance at the time, Peter had another angle, which was the VC side of things. And what I was fascinated by his way of expressing, his macro view through, a very super liquid short S&P future trade versus being long Facebook on the venture side. And so I caught that bug essentially. And in 2008, I started as an angel investor. Now, I moved along. I joined other firms, but Bellegarde Capital is a Swiss family office where I served as the CIO at the time. And essentially, the founder of the family office was my previous boss, who trusted me and gave me an unconstrained mandate. So as part of the unconstrained mandate, an unconstrained mandate helps a lot in generating better returns, because you've got that flexibility, which is a huge advantage. And there, so I started building a pocket of fintech investments, but we had to be focused. So it had to be a European fintech. We focused on European fintechs. And so the way I built that allocation was to either co-invest with venture funds that we knew, or invest directly in. And some of the co-investments and direct investments were in TransferWise, in N26, iZettle, which was bought by PayPal, and other Swiss ones. So it was a mix of co-investments and directs. And when you do fintech, and that was around between 2012 all the way to 2015, one of the founders, we were incubating some fintech companies as well. And one of the founders approached me in 2015 and said, hey, that Bitcoin is quite serious. You should look into it, and convinced me to look into it. Put me in touch with one of the founders of Bread Wallet, which was a wallet for Bitcoin at the time. And I spoke to them and I started transacting on some Bitcoin. I sent some Bitcoin back to my home country in Lebanon, as a test. And, I was really fascinated by Bitcoin, but it wasn't interesting enough to get involved. In 2017, 2018, Zug close to Zurich was exploding in terms of activity. There was the concept of the crypto valley, etc. There was a lot of activities around ICOs, Ethereum, etc. And at that point, it became really interesting. And so we started getting involved as a family office. But when I realized that Zook was not the center of crypto, I realized that there weren't good providers, asset managers, or crypto asset managers in Switzerland, and know that there's a big pool of capital in Switzerland, whether it's family offices, pension funds. I approached my boss at the time and my co-founder today, and I told him, listen, I want to set up my own thing, and decided to set up L1D at the time, based in Zurich in 2018, to essentially bridge Swiss institutional capital to the global opportunity set at the time. And the reason why we started with funds is essentially I wanted to replicate all of my past experience. And we started with funds because we felt that, any 99% of anything that touched crypto was complete garbage at the time, and maybe still is. And we needed help to source the 1% of quality. And so this is why, we started with funds, similar to that fintech approach of, partnering with well-known VC firms to give us access to TransferWise at N26 and other deals. We started doing the same in crypto and expanded from there.
All right. So what was the attraction to crypto? Because you had a very successful career in traditional finance. Not many people in your position would say, hey, you know what? I'm doing pretty well. I want to go into this crypto thing, which back in 2018 and 2017, it was looked at as kind of a, people were excited, of course, but it was kind of looked at as a joke, broadly speaking. So why would someone of your caliber decide, hey, you know what? There's actually something here. I want to make that leap. Because for you, there's a high cost.
Of course. So there's a personal reason and a professional reason. The personal reason is crypto was really interesting to me because the trustless side of things was very interesting to me because, I grew up in Lebanon, and in Lebanon, you're trained not to trust anyone, to be fair. So as, whenever you do business in Lebanon, you need to watch your back, number one. And number two, we've seen the hard way that there was a financial crisis many years later. And that financial crisis was very easy to predict. Our beloved central banker at the time was running probably the biggest Ponzi scheme out there, and collapsed the entire system. And so all banks are broke. Lebanese people lost roughly 85% of their savings, even if they had them in dollars.
I'm very ignorant. So the central banker of Lebanon was running a Ponzi scheme?
Yeah. So Lebanon was running at the time and continues to. The reason why some people call Lebanon the Switzerland of the Middle East, there's many reasons. Well, we have mountains, we can go skiing, which is great in the Middle East. But also you had banking secrecy in the Middle East, in Lebanon. So you had a very large banking system. A banking system that essentially served for the Lebanese diaspora abroad, where, successful Lebanese would, and, some of the dishonest ones, to be fair, would hide their money back in Lebanon because of that banking secrecy. But at some point, you had some political changes where, the Saudis stopped investing in Lebanon and keeping their money in Lebanon. That was a big pool of capital. They were big clients of the Lebanese banking system. But also you had new global regulation that came into place where countries would exchange data about clients. And if I'm a Lebanese in Switzerland and I've got my bank account in Lebanon, the Swiss need to know that I've got a bank account in Lebanon because they need to tax me accordingly. That started in 2018 or so, if I'm not mistaken. But so on paper, for a very long time, you would talk to any emerging market macro hedge fund out there. They would tell you Lebanon on paper is bust, but for some reason, default is not being triggered because you had that Ponzi scheme going with the Lebanese diaspora, which was very wealthy, channeling a lot of capital back into the Lebanese banking system. And the way the central banker would do those tricks was to, on dollar deposits offer very high interest rates. And so the Lebanese would run that carry trade, be very happy about it. And of course, such a carry trade is very bad for the economy because you're sucking all the liquidity and no one is investing in businesses, technologies, etc. So this is what happened. And so once there was a point where that Ponzi started unraveling. They started offering interest rates that were, I would say, out of bounds. And the reason why I was aware of that situation was because in 2009, after the 2008 crisis, our central banker at the time was elected or voted by some counterpart, I don't remember who, to be the best central banker globally, because the Lebanese banks were some of the only ones not to have exposure to subprime, US subprime. And so it gave me a flashback of our time in Argentina, where I remember visiting hedge fund guys in Argentina that would tell me that the Argentine government at the time was forcing Argentine pension funds to buy local bonds. And it was the same there. So the reason why the Lebanese banks did not have exposure to US subprime was because he was forcing them to buy local bonds. And that was the Ponzi. So Lebanese depositors would come in, the central bank would force them to buy local bonds to bail out the Lebanese government, and that was the actual Ponzi. And they were offering very high interest rates, but the debt to GDP was one of the highest in the world. And at some point, the system broke, and your dollars were worth 85%, 90% less of their actual value.
Okay, so that makes total sense from the you being attracted to the trustless nature of Bitcoin, and that was on the personal side. I mean, obviously, going through that experience would it would make it very apparent to why this technology is needed and the broader potential. But from the professional side, what was that thought process? Because again, very successful. So why jump ship?
So one of the biggest fear in finance, and one of my biggest fears in finance during my career was alpha decay. So as you've got an opportunity set, you've got a spread or a premium. As soon as people understand that premium, understand the risk, they come in and they extract it. And you need to move to something else. And if you don't, as an investor, I'm talking, you have to move to a role within finance where you're providing a service. Either you're in sales or you're in DCM, etc. I started as a trader. Initially, I was trading, the curvature of the European and sterling yield curve. It was very profitable when people were panicking out there. Sadly, one of my most profitable days was during 2005, during when London was under a terrorist attack. So spreads exploded, people were panicking. But then this opportunity started fading away. So I moved to a fund of fund. At the end of 2008, I was very active in distressed. A lot of hedge funds out there in 2008 had illiquid assets within their books that were side pocketed. I was one of the buyers of those side pockets. I would go in, price them, and take, be a liquidity provider. I did that between 2008 all the way to 2012. I moved into fintech because that opportunity set was live. But it was a race against, alpha decay. There was a lot of competition. There was a lot of capital. And in TradFi, alpha is very scarce, especially on the liquid side. And, even on the illiquid side today, it's pretty difficult. Investors are not very happy with returns and stuff. And then you've got crypto that presents itself. 99% is complete garbage, but you've got 1% of quality. And there's a lot of alpha that is present in crypto. But most importantly, what was really interesting for us was the asymmetry that was presented within crypto. And so that attracted me. So the availability of, the potential of generating alpha as an active manager, number one, and the asymmetry attached to it. So when I left the fund of funds, as I said before, I believe that I made a career mistake by moving from trading to a traditional fund of funds. I felt that the model was completely broken. But for me to start a crypto fund of fund, I had to build enormous conviction in that model. And the only reason why I did it is I built it in a very different way, but also it was the environment that was presented by crypto markets. The fact that there was so much, the market was extremely immature, whether we looked at tokens, companies, security, liquidity, or managers that presented the case for L1D essentially.
So touching on the alpha decay and TradFi, how do you see that going forward in your opinion in traditional finance? Is it literally like, do you actually think that the alpha is pretty much stripped out in all of traditional finance just because we've gotten so advanced?
Yeah, 100%.
Wow, that's a crazy thing to like think, 'cause like alpha is almost gone in traditional finance.
One of the best indication of that is the major consolidation that you've seen across the hedge fund industry. Today, the traditional hedge fund industry is dominated by few players. There's a lot of hedge funds out there, but most of them, are struggling to survive. And the biggest ones are, what are we talking about? We're talking about, I'm giving you examples. I'm sure I'm missing some really good ones, but Millennium, Citadel, etc. So that consolidation is Blue Crests or others that are exceptional. They're not actual hedge funds. It's a family office, but it shows you the power of certain brands or certain hedge funds out there that are in control of that alpha. The typical journey of a traditional hedge fund manager is, well, back 15 years ago, is you launched, you did well for a certain period of time, you reached peak AUM, and at some point, like it's not worth your while, you're unable to generate alpha, your investors are giving you a hard time, so you convert into a family office. And that's what's happening. So today, you either convert into a family office, you're lucky you've made enough money, you've got the freedom that you want, you're unconstrained, you have no investment guidelines, or you join a platform like Millennium or Citadel. And so that's a clear indication that alpha is really, really scarce. I'm not going to say it's completely gone, but it's gone for most. And you need to have real edge to be able to sustainably deliver on that promise.
Okay, I want to touch on alpha and crypto shortly here, but okay, so you want to enter fund of funds first because there is so much garbage out there within crypto, and you said, okay, we want to identify the folks that do have that edge, that can identify that top 1%. At that early stage, 2017, 2018, that was when it, quote unquote, institutional crypto, like crypto funds, were first forming. Essentially, you had Polychain, Blockchain Capital, a few others, but pretty much it was the dawn of the industry as like an asset class. How were you able to identify these managers at that stage? Because there wasn't a lot of data to support the thoughts and theses that these managers had.
Yeah, I mean, absolutely. So not only tokens were garbage, but most of the managers back then, and I mean, they're much better today, but back then, most of them were uninvestable. So you could not approach your selection process as a traditional fund of fund where they go through databases and they compare returns and then they come up with a list and they start calling them and having calls with them. It doesn't work that way, not at all. At the time, and it continues to be the case, by the way, the process is purely bottom up. So you're meeting people, you're being referred. It was a small community. It continues to be a small community, but it was an even smaller community at the time. You identified, you had references on specific managers that had, and at the time, you had two types of managers when we started. You had the managers that had, it's all relative, of course, a high brand towards investors. I'm not going to name them, but at the time, the large funds at the time, and you had the funds that had a high brand towards founders. And so we favored the ones that had a high brand towards, that were loved by founders, because we thought, you know what, we're not going to join all the investors. We don't need references from other investors to decide if we want to invest in a fund. We'd rather listen to the founders, because it's all about access. And if you've got access to the best founders out there, or that 1% of quality, the asymmetry will take care of the rest. That was the idea. So it was really tough at the time, but it was all bottom up, going to conferences, traveling. Before setting up L1D, it was nonstop travel for 8 months. To build the network, as we've done before. So I've done it several times. I did it on the fintech side. I did it to source those distressed deals for hedge fund side pockets, et cetera, et cetera. And so we use the same process to build our network quickly, but that required a lot of traveling, joining conferences, invite only. At the time there weren't a lot, but one of the major ones was April 2018, Half Moon Bay Multicoins Conference. This is where I met Kyle and Tushar in person. But building a portfolio in November 2018, which was the first month for the fund, was very, very difficult. And having the conviction, we've come a very, very long way. But it was hairy, to say the least.
I don't think you can't have participating in crypto for any sort of a length of time without it being hairy at some point, right? It's so chaotic sometimes. All right, so 2018, 2019, that was kind of the era of crypto hedge funds. And then I'd say 2020, 2021 was like crypto venture funds. You guys have a little bit, you guys have both. But also crypto is this odd beast where it's kind of a mixture where you want some equity sometimes, you want some locked tokens sometimes, kind of in a venture style investment, and then you also want liquid. What was your approach in the early days of portfolio construction between liquid funds and venture funds?
Okay, so initially it was the first fund that we launched was an open-ended fund, so we had to be relatively liquid, and the approach was a bit of a mistake, to be fair. So again, I came from TradFi. I was influenced by that. Hey, let me suppress volatility a little bit, and the way I wanted to suppress volatility was to come up and say, I'm going to do 50% of the book will be fundamental measures that will be directional, they'll be volatile, and 50% will be market neutral managers or traders. That 50% was a mistake, in my opinion. And I learned the hard way, more specifically March 2020, when those strategies that suppress volatility, whether they were market neutral or discretionary traders, one of the ways where you suppress volatility is by saying, hey, I'm actively trading. So I'll, lower your downside and I'll suppress, I'll cap your upside, I'll lower your downside. And if you're a discretionary trader in crypto, I don't think anyone, it's pretty tough to handle because this is where you have a lot of PM burnouts. And when you have a burnout and you don't have the governance around you to make sure that you don't do anything crazy, well, you actually end up doing something crazy. Either you apply leverage or you get chopped up. It's extremely dangerous. And so that was the first setup. So 50-50. We learned the hard way that, actually the trick is, and we started educating our investors very aggressively, that the trick is not to suppress volatility, but to underwrite it. This is the risk that you're taking. Because at the end of the day, you're exposed to venture that is liquid. So you need to pay a price somewhere. It's volatility, market risk. But you need to make sure that volatility is not, even if you're down 50%, that you're not realizing those losses. It's mark to market. You have to consider it as if it was a venture fund that is liquid. You can change your mind if you like to. You can choose your DPI on the liquid side. And so that's how we approach it. The way we started moving into venture was to complete so we're one of the largest investors in our funds ourselves. So we used our funds because we wanted to have exposure to the space, and we managed the book on a look-through basis anyway. So we're very close to our managers, and so we don't allocate to a manager and say, okay, it's all good. Especially on the liquid side. On the venture side, it's different, but on the liquid side, we manage the book on a look-through basis, and then we reconstruct the portfolio because essentially what we want is their sourcing for us. That's their mandate. They're sourcing that 1% of high quality for us, and they're managing the risk. But at the end of the day, we want to know where we're exposed and stuff. And that's really important because at the time, on a look-through basis, we knew that we were long, applications on top of Ethereum back in 2018, which is great because then you had DeFi, NFTs, etc. But we were also long alternatives to Ethereum, which is Solana, through the multi-coin team. And that was a beautiful combination of risk because you're like, okay, I'm not sure who's going to win, but if one of them wins big, we're good. The asymmetry will take care of the entire book. But you could only know that if you would run the book on a look-through basis. Now, to complete the rest of the stack, which is at the time you had liquidity was an issue for crypto, security was another one. You needed to invest in companies that provided those services or took care of and enabled the maturity of crypto capital markets. So at that time, we started investing in VC funds, but also in directs to reflect what we did on the fintech side, which is we invest in VC funds that will do early stage and will follow on through direct investments. So a perfect example is Multicoin Capital was seed stage with Solana. And then when Solana, the round of 2020 of $6.5 was around where we participated because we come after. So that's a perfect example of the way we do things.
Very cool. Okay, so how do you think about tokens versus equity in both your fund of fund investments and also your direct investments?
Yeah, looking back, clearly the so we intentionally wanted to have exposure to equity investments back then because we wanted to cover those or provide exposure to our investors to security, liquidity, etc. So, for example, that Wintermute investment, to be clear, was a co-investment with one of our funds, and that is and despite the fact that of course equity was another way in hindsight, another way to suppress volatility, right? You had a lot of institutional investors that would say, hey, yeah, I like crypto, I like blockchain, but I don't like crypto. And some managers will say, oh, you like blockchain, so we'll do the equity side. You understand the equity side, we won't do crypto for you. And that was the wrong decision. We didn't do it for that purpose. We did it because we wanted to fund companies that were taking care of those really important crypto capital markets features. But at the end of the day, you had less, you didn't have, if you would have invested in a venture fund that did tokens only, your DPI or your results are way better from a DPI perspective, a TDPI, etc. The equity side is, has lagged in a major way. There are a few exceptions. So, for example, there was an opportunity to exit your co-investment in Wintermute. That was one of the exceptions. But there weren't enough exits because obviously the IPO window was completely shut. This could potentially change in the future. But it's a part of the book that is very different from the liquid side. We're still happy with it, and we'll see how things evolve on the regulatory side and the IPO window, essentially.
Yeah, and then in fairness to the folks that were focused on equity, the entire, not just for crypto, the entire IPO market, as you mentioned, has been completely shut, and even traditional venture funds in Web 2, they're also not getting massive amounts of, or if any, DPI. So it's been kind of rough out there for venture as a broad category. So,
and I think one of the lessons is, you need to invest in things that are unique, right? At the time, it was unique to invest in a token-only fund. No one wanted that. And maybe today, it might be unique to invest in an equity-only fund. Who knows, right? I mean, being contrarian and non-consensus in crypto pays off.
Yeah.
So let's see.
All right. So how do you think about when you were deploying into these funds, how are you thinking of the portfolio allocation in the sense of, okay, of course, there's different strategies, whether it be venture or liquid or whatnot, but we were also thinking in terms of, geographies and, manager profiles, or were there subcategories that you were looking into? Or was it really like, okay, what type of, of course we're going to do DD, the managers and whatnot, but we're looking at what strategies are these guys doing? Was that the kind of the primary focus, was strategy only?
Yeah, I would say that over time, the top down or the strategy selection became way more important, just based on all of the lessons and the mistakes that we've done in the past, which is, there are managers out there that don't agree with me, and publicly will say it, will come out and say it if they listen to that podcast. But essentially, we believe in the fact that over trading or suppressing volatility by trading heavily is dangerous, and we try to avoid it. So our largest positions are liquid fundamental managers that run what we call static market risks. So they hold on to their positions. So their net exposure stays at 95 or 100, and that's it. So if there's a bear market, they will incur mark-to-market losses, and they're underwriting idiosyncratic risks. So their edge is in selecting the right tokens, and if they're right, they end up being the best performers. And if you look at historically, most of the alpha came from those strategies. Not only because the market is up, no, because that's the beta part, but the outperformance on top of Bitcoin or anything else came from a very, very small number of managers that run those strategies. Because you're not exposed to all the other challenges of, oh yeah, I need to suppress my volatility for my investor. I need to be market neutral. It's just those strategies are you're looking for short-term alpha, and short-term alpha is not sustainable. Long-term alpha, an alpha over 1 or 2 cycles, is much easier in crypto. But the cost is, in a 2022 year, you might be down 85%, 90% on that line item. And that's okay. If you understand the risk, that's all good.
So you are what I would categorize an LP that understands, right? There's a lot of LPs out there that don't understand that. Like I think, that, hey, liquid tends to generate the best alpha, and you will be on for the ride, essentially. And, you mentioned like numbers of 80, 90% down. That for most LPs is catastrophic. That's like beyond catastrophic. It's like outrageous. And being liquid, a lot of them will pull out. And yes, there's gates and there's sort of structures that you can put in. But, in your opinion, have there been other LPs, or have there been broader education among crypto LPs that, okay, that is kind of what I should be prepared for, and I'm okay with that? Because when I hear you say that, I'm like, man, that'd be great, if LPs all thought the same way you did, because logically it makes sense and mathematically it makes sense. But I just feel like it's a very, very small amount of LPs that have that.
No, they don't. And if they did, I think the opportunity set would vanish altogether. So I'm happy that they don't. And just to give you an indication, so there's two aspects. So there is one very well-known manager out there that was down heavily in 2022. And because we understood that risk and we had learned together from March 2020, where that manager was more of an active trader in March 2020, and they had a really tough time, and we had that tough time together. We came to an agreement together that they would stop trading and would focus on what they excel at, which is selecting tokens. So if I agreed with them that this is what they should do, and run essentially static market risk, how can I blame them to be down heavily in 2022? That's what I asked them to do, right? I did say publicly that we were the only one that invested in them or doubled down after FTX, because we understood exactly that risk. And I know that most investors, and there's investing after FTX is really tough, but we had a mechanism in place that, in a way, if we followed our process, we had to invest. And I can explain why. Like I said before, we run the book on a look-through basis, which means that we aggregate all of our risks. So I know that, I want to run a certain amount of aggregated market risk at a certain point of time, a minimum and a maximum. If FTX is collapsing your market risk and takes you below your minimum, you're forced to invest in a way. If the opposite happens at the end of in November 2021, where organically your market explodes, you're forced to raise cash, right? So when you have an FTX, you understand the risk, and you're at the floor of your market risk. So that means that you need to invest. There's no discussion at the IC. That's what we're supposed to do. And by the way, because we like that asset on a look-through basis that got battered, we're going to double down on that manager and that asset because we like the manager and we like the assets. So it's a double win. Now, the fact that everyone else doesn't understand that is a good thing for us, because this is where we come in. You're right that no one would be able to handle that line item volatility, but this is where we handle it, because, as if we run a fund of funds, we're more diversified. we've got many line items, and we can absorb those shocks for them, and we can make those hard decisions for them. The educational side of things, especially for today, we have 8 Swiss pension funds invested in us, and most of the pension, they're invested in our venture funds and our liquid fund of funds, but most of them are invested in the liquid fund of funds. And there's several reasons for that. Number one, Swiss pension funds have a 15% cap on their alternative investment allocation. And this is where we would fall in. Beyond if you go above the 15%, you need to talk to the regulator about it and say, hey, why am I above the 15? Now, if you think about the composition of alternative investments for a pension fund, what is it? We said before that you can't find alpha in traditional liquid strategies. It's very difficult. So hedge funds, the hedge fund allocation for Swiss pension fund has gone down significantly over the last decades. So they put everything into infrastructure, PE, illiquid strategies. So if you come up and say, hey, I've got a liquid strategy that has massive asymmetry, has long-term alpha, but there's one price, you need to take on the volatility. They say, yeah, I'll take it. How do I deal with the volatility? Yeah, you size it appropriately. So typically size between 75 basis points and 2%. Now, if the asymmetry kicks in and you're up, so our first pension fund joined us in 2019 and doubled down in March 2020. So at the end of 2021, they were up 10x. But that 75 basis point is a 7.5% position today. They're above their cap. They can redeem and recalibrate, which is very, very valuable for them. And so this is where you have, that's one example of a situation where if you explain, you're transparent about the risks, the fact that this is venture, that is liquid, the beauty is that you can recalibrate to make sure that you're below that 15% because you have the liquidity. The cost is mark to market. But as long as you don't realize that you'll be okay, then, institutional investors are really understanding of that.
That's amazing. Wow. All right. So going back to the managers, are there correlates to successful managers that you found, whether it be like certain personality traits or whether it be, I don't know, they all tend to live in Austin, Texas, or, like, hey, I'm just, throwing things out there. Are there any correlates that you've discovered, or is it pretty kind of randomized?
Yeah, I would say that first, really successful ones are really, really rare. I mean, there aren't a lot. Like, there's maybe 2 or 3, not much, unfortunately, but it's okay. Because as long as you have one of those, then it takes care of the rest. And I would say that some of the commonalities among those are, so the basics, the have to have. And the way I divide it, I tweeted about it a few months ago, is the concept of a GPA versus a GPB. A GPB is a manager whose priority is AUM growth, and so they make a lot of money from their management fee. So they're less interested in performing in a way because they're in a very comfortable position. So a lot of managers start really well, generate alpha, do really well. As they grow, they become very wealthy, and they're incentivized to run a big firm, and they're incentivized to perform less and take less risk, essentially. They over delegate to their teams, they build big teams, etc., because it's more institutional. Those are no-goes, in my opinion. So GPBs you want to avoid them. Sometimes they're difficult to identify early, but you need to identify them early and get out. The GPAs are the one that are where the initial PM is still the key man risk. They've got a small and very lean team. They've got their team members heavily incentivized. So, carry points, part of the GP, etc. And their main source of revenue is their performance fee, essentially. Now, if you take that and you couple it with, real independent thinkers that are non-consensus to contrarian, then you could come up with a mix that is explosive to the upside.
Very cool. All right. So alpha decay in crypto. What are your thoughts? Because TradFi, you said, has essentially been stripped of alpha, broadly speaking. How many more is that the case today? Probably not, judging off based on our conversation, but if not, how long do you think we have? Do you think we have, because TradFi is entering, especially now with the new administration in the States, do you think we have, 5 years, 10 years left, or do you think it's going to be maybe a 40, 50-year stretch where generating alpha is going to be available within the crypto markets?
I think it depends on strategies, but I would say trading strategies don't have long, to be fair, because as soon as regulation allows some of the big TradFi boys to come in, yeah, the crypto native ones are toast. It's over. On the fundamental side of things, especially on managers that underwrite idiosyncratic risk, I think it's different. I believe that there are managers that are able to create their own alpha in a way. Like there's maybe one or two managers that are such a brand today that they have access to any deal out there, even are able to create narratives. Like they put a segment on the map. And that's a huge advantage because they drive narratives, they drive activity, they drive investments, etc. As long as those managers want to stay in the game, we're going to be okay, or else we're going to have to replace them with new talent. And essentially I think there's a natural role of managers that will come on top every few years. The best managers of 2018 are not the best managers of today. The best managers of today might not be the ones of 2027, 2028. I'm not sure. I'm hoping that at least one of them stays hungry. But one of the biggest problems in crypto is, wealth. You can reach wealth really quickly, and it's understandable. We're all human. Some managers out there are like would rather enjoy their life than grinding further for the cause. So this is very scarce.
That makes sense. So on the venture fund side, what do you think in terms of where's alpha lie on the venture side? Is it access purely?
Yeah, I would say so. I would say access, and I would say that today we're in a situation where the consolidation is going to happen. The consolidation that we talked about on the TradFi hedge fund side will probably, in my opinion, happen on the crypto VC side next, because there's 5x the AUM in crypto venture versus liquid funds, which is abnormal. It doesn't make sense. That ratio needs to be recalibrated, or else the venture funds won't be able to sell their tokens to sophisticated players out there. For the sake of VC, we need to see more AUM and more institutional flow into liquid funds. And I think this will happen by seeing liquid funds outperforming, attracting more AUM. And so it will take a few years for this to happen. But also, I think because there's so much competition on the venture side, there's so many venture funds out there, that the consolidation, in my opinion, is already happening. And if there's 2 or 3 funds out there that will absorb most of the flows, they will never have any issue in raising capital, and the rest of the market will really struggle.
That makes sense. All right. So on the direct investing side, how are you sourcing your deal? The deals that you guys participate in? I would imagine it has to do with the funds that you're currently invested in, and you can kind of see, okay, hey, Bitwise, for example, is doing quite well based on our updates from this fund that's invested. Therefore, we want to triple down. Is that kind of the flow, or how do you guys do that?
Actually, no. It might represent maybe 5% of the flow. So the policy is, number one, we do not want to compete with our managers, and we're not gonna go 100% direct one day. That's not the intention. We will. Again, it's a reflection of what I've done in the past, which I've done funds, co-investments, and directs, and it worked really well. And so I wanted to replicate it on the crypto front, and it makes a lot of sense. But on the direct side, you cannot rely on your managers to source for you. It's not possible, because during bull markets, they can't. And obviously, everyone has great intentions, but you will never see the best deals out there. They'll never show you the best deals. There are exceptions, of course. Solana, I met Raj in Singapore in 2019, but Kyle reintroduced me to Solana just before the round, and gave me a heads up, and that was really that was great for us. There are obviously there are exceptions. So the way we need to be able to source ourselves, that's really important. So we have a team. We have a team that is very dispersed in terms of abilities, backgrounds, etc. So We have someone who's extremely technical within the team, someone who's a degen, someone else who's focused on token economics, etc. And so that blend, those are the ones that focus on sourcing, number one. But also we use direct investments. We believe that it is very important for us because it will help us perform, in our opinion, but also it helps us select managers better, if that makes sense. Because we think about, portfolio construction, etc., and we can talk to our managers and say, "Hey, guys, we're looking at your portfolio. Why do you have so many positions? Why aren't you concentrating your bets, in line with your convictions, etc." We're able to be smarter, a smarter allocator if we do things on the direct side. We talk to founders ourselves. We continuously check if the brand of our managers are still intact, are getting better, getting worse, etc. So there's a lot of information that flows in. But most importantly, we never want to compete with our managers because our managers are positions that are really important for us. That's the approach.
That makes sense. What role do the crypto, we were speaking about narratives earlier, but crypto subsectors play in how you think about the market? We have like infra, DePIN, gaming, AI, et cetera. Does that play any role in how you guys approach the market or how you guys think about, allocating?
Yeah. So if you take two things into account that are part of our DNA, first point that is part of our DNA is by nature we're less consensus. So we get excited when there's big moves to the downside and people are scared. We get more excited naturally. So most of our investment activities are during bear markets, especially on the liquid side, because bear markets give you the ability to step in. You have the time to de-risk operations, to negotiate, etc., to set to structure a deal. So bear markets are really, really important. And number two, we don't really like to compete. So if you have an area of high competition, like it's a turnoff for us. So we'll go to the areas where there's less competition, which is linked to my first point. So for example, 18 months ago, we were more active in DeFi as part of on the direct side. So one of the deals that we did was we did an OTC with Pendle. We loved the team, we loved the product, and back then, the whole market was unloved, Pendle was unloved, etc. And so that Pendle, during the correction in the last 48 hours that we saw, we used that opportunity to increase to our Pendle position. So that's perfect for us. 8 months ago, we started building a gaming vertical because gaming was unloved, and so the team started structuring an approach to gaming. They're gamers themselves, and essentially we started building a portfolio there. This is how we essentially do things, and we shy away from going after the hottest segment there, because if we do, we're gonna have to compete with everyone, and where it's not in our nature to compete with everyone.
If you had to kind of create a one-liner or thesis philosophy, like what would you say is the overall investment philosophy of L1D? And has that evolved over time?
So the investment philosophy is essentially fulfill the promise to our investors, which is to provide the asymmetry that you have in crypto. And so you need to capture a major part of the upside and be able to outperform. And the way we want to do that is by running a specific amount of risk that lets us sleep at night. So just to be clear, in a 2022 scenario, we cannot be down 80% because you need to be able to operate within your comfort zone, and there's a limit to our comfort zone. And that comfort zone is at maybe 70% of that number. This is where it's capped. And so you do that through diversification. So we need to be able to, serve our institutional investors by providing the upside, but with enough diversification. And I think the way you improve your ability to have access and add value to the space, because it's give and take, is by being most aggressive during bear markets, because this is how you add value to the space, because your capital is worth much more, and you're able to de-risk and make even managers more institutional. And essentially, our role is to be non-consensus contrarian and take some, really tough decisions when most are not.
Can you describe I mean, this is gonna be easy because you've been in the space for a while, but can you describe a challenging or a very difficult moment that you guys have gone through as a firm?
I think it was 12th of March. It was 3:45 in the morning. I was chatting with all of our managers because at the time um, uh, we only had that liquid fund of funds. It was really tough. I didn't know if we were going to survive that period. We took a step back. We learned from a lot of mistakes that we had made, especially with that whole, volatility compression approach. And we realized, you know what, there's no free lunch. We need to focus on what makes sense in crypto and has nothing to do with TradFi. You need to rewrite your TradFi rules. You can't treat volatility as a risk factor. That's You can treat realized volatility or realized mark-to-market losses as a no-go, but non-realized mark to losses is something you want to take on essentially. And so since then we've shifted completely, and it's gone. We've done much better since then.
Very cool. And you mentioned this before, but team building. How do you approach team building? And you mentioned previously you're kind of one of very diversified group of folks that have different skills. When you're building your team, what are some other factors that you're looking at in terms of, hey, I want this and we need XYZ skill set, et cetera?
So I think the skill sets needs to be very complementary, from a knowledge point of view, a network point of view. So that means that there's people of very different ages, naturally. Geographies are important. Presence in, especially now, right? I mean, the US is the most important market in the world by far. Being in Zurich, is that an advantage? I'm not sure. So we need presence in New York, which we have with two of our partners. And at the end of the day, what you need to do is you need to have someone. I think it's important not to waste time with turnover. So you need to incentivize. You need to make sure that they're in it for the long term, and you need to incentivize accordingly, which many GPs out there ignore. So whether it's carry points or what we do is that we need to make sure that they're on the GP's cap table. No phantom equity or actual equity. That's really important for us. But still, despite all of this, it's tough. It's not easy. As I said before, the easiest way to run a firm is to have an unconstrained mandate. And that even involves, an IC that is very restricted, very nimble. And as soon as you have more and more people, more processes, you need to make sure that the processes don't hamper your ability to generate good returns. And because typically that's what happens. So there are challenges.
How do you expect the crypto asset class to evolve over the next few years as what we think might happen, hopefully? There'll be pros and cons, but I think broadly very positive. But there could be a big change in the kind of institutional adoption and outlook of crypto over the coming years. Yeah, how do you expect crypto to evolve?
There's a bit of an issue, actually. I think there's a big gap to be filled, and needs to be filled, or else we're not going to get anywhere. So I spoke about it. It's the managers that come just after venture fill the gap after a TGE. That come in, look at a project. There's a TGE. They price it, and they say, okay, should be priced at that level. And at that level, I'll take a big piece and I put it in my portfolio. That is the gap that needs to be filled today. And I would say that the two extremes, which are venture and ETFs, are very, very crowded, understandably. So there's a lot of flows in ETFs. So those are the extremes. There's a lot of flows in ventures, or where no longer flows into ventures, but the AUMs are very large. And in between, you don't have much. I think the trading guys, when they will operate on tokens that are more mature, they'll get filled by the TradFi counterparts that will enter the market. But that liquid venture bucket is, there's a major gap there. And so I'm hoping that the flows will come in. But the problem is that today we don't have enough high quality managers to take on those flows. So there's a great business opportunity out there for managers to launch within that bucket, build an edge, build teams. We need to play the role as L1D to find as many, even help form some talent there and teams and push forward, or else things are not going to work out.
Very interesting. So what would you say is the grand vision for L1D? Like, let's say 10 years in the future, where do you want L1D to be and, how are you guys operating?
I mean, it's pretty simple, is to make sure that we generate alpha to our investors, which is very, very challenging. And that pushes you to manage your size accordingly. Because at a certain size, as I said, high quality has capacity constraints. You want to outperform for your investors. You need to make sure that you add value to the space by coming in and capturing the misallocation of capital that is out there. So for example, today it's liquid markets, liquid funds. This is the biggest opportunity in our opinion. Maybe the next one should be to deal with the next gap in the market or the next problem that we need to solve as capital allocators. And we need to move from one problem to another and add value to the space, or else we won't be able to perform.
All right. What are you personally excited about within crypto? Which kind of, is there any technology? Is there any subsector? I don't know, stable coins, et cetera, or agents maybe? What has you very intrigued?
Yeah, I'm excited, but very cautiously excited, because I need to see how things evolve. We were, because of the fact that we're based out of Europe, we were early into DeSci. So we invested really early in Molecule, in VitaDAO, in Beaker. And that was several years ago. And we saw all the explosion in mindshare recently, and that cooled down also recently. I'd love to see them succeed. We'll see if they do. But if they're able to succeed, I think it would dilute some of the other areas that are less rosy within the space. But again, there are criticisms out there that are very valid. So I think the ecosystem and the community has to work really hard to make it work the proper way. But as a next TradFi trader or allocator, etc., DeFi is super interesting for us. And the fact that that whole financial crisis in Lebanon that took place, you would have avoided the whole thing with stables, DEXs, decentralized borrowing platforms, etc. So it'd be ideal if we're able to have some adoption in some of those countries.
Totally. The meme, they say just use Aave, right? It's like just like chill, use Aave, like you're fine. So no, absolutely. Very cool. All right, Ray, are you ready? First of all, thank you. This has been an incredible conversation. I appreciate you taking the time. Absolute wealth of knowledge. But are you ready for the closing questions?
Yeah, sure.
All right. What is a belief that you once held strongly that you've since changed your mind about?
I mean, the strongest belief was that you need to run strategies with high sharps and, the absolute return myth out there. That's how I traded. It worked. That's how I was educated to allocate back then in traditional hedge funds. Yeah, it's a complete myth. It doesn't work. And so I learned the hard way with crypto that you need to flip it around and make sure that the thing that keeps me up at night is the error of omission, which is if I miss a big investment, I won't be happy, and we would fail as a firm, and not suppressing the vol and making things and targeting a certain sharp ratio.
What's been the most defining moment of your career?
Defining moments in my career would be probably the 2008 crisis. I can say that I started investing personally in 98 or 97, and I've lost money consistently from 97 all the way to 2008. And 2008 was the time, and I think they say in TradFi back then, when you're at a trading desk, if you haven't gone through a major crisis, you don't have any experience. So 2008 was really, really formative for me. It was a situation where you would come into the office and every day, like, things would cascade one after the other. Every strategies, whether it was fixed income arb, US municipal arbitrage would blow up. Everything was blowing up. And so that experience was really useful for me because since then, after 2008, something clicked, and I was able to generate returns after that. Things completely changed. But that experience first came to mind when we launched in November 2018. If you remember, in November 2018, on the 15th of November, markets were down 50%. So I put on that 2008 hat and I went into war mode. And that was really, really useful for us because I needed to make sure that we would survive that period.
That's amazing. Wow. Yeah, I remember that period in 2018 November. That was like I was like it's I didn't honestly think it was all over, but I was like very depressed. I was like, oh my gosh, this is terrible. Because the sentiment was already extremely negative. So that was a cherry on top. All right. You go back in time before starting L1D, you give yourself one piece of advice. What would that be?
Move to the US.
Interesting. So you launched in 18. The past 4 years of crypto within the US has not been, very rosy. You still think that would be the advice?
Okay, what are the most where are the most successful and largest funds out there in crypto?
That's fair. Yeah. Very nice. Awesome. Love that one. All right. Last one. If you could sum up your life philosophy in a single sentence, what would it be?
Be contrarian.
Ray, thank you. This has been an absolute pleasure. I appreciate you coming on. Where can people find you and learn more about L1D?
We've got a handle on Twitter, L1D _ SYZ, and Ray L1D, Ray L1D as well on Twitter.
Thank you, sir.
All right. Thank you so much, Andrew. All the best.